Uh, Good evening, everybody. Hope you guys are well, had your dinner. Welcome to our Saturday evening session. This session is brought to you by �11 Malaysia. As you can see, I am not at my usual location, going live with you. I'm away from my desk. But tonight's session is brought to you by �11Malaysia. And we're going to be talking about financial numbers. Okay, so I'm going to make sure that I don't bore you guys, and to make sure that I'm going to keep this session as interesting and as educational as possible. All right, so stick with me. All right, if you have any new how do I say new, if you know anyone who are new investors and would like education and would like to find out more and learn for free, get them to join these sessions. Well, you can still invite them now. You can tag your friends at the bottom, and to watch this. Of course, this is recorded. You can also watch it after this live session. What we're going to do is I'm going to start off with the session, and then of course, if you guys have any questions, just keep them posting below, either whether you're joining us from YouTube or you're joining us from on Facebook, right? So this is segment number 1, 2, 3, 4. This is segment number 5. Yeah, so we're doing 10 segments in total, and these sessions are all brought to you by �11 Malaysia. Do check them out. I guess if you're invested in stocks, you'll know what �11 Malaysia is. �11 Malaysia is our Malaysia's official stock exchange, right? And this segment is brought to you by them. Okay, so let me. So if you guys can hear me loud and clear, if you can just give us a comment below. Right. Good evening, all of you guys who are texting at the bottom. Welcome. I see some of you guys are starting to stream in. This is the first time I'm going to do this with a single screen. So let me see if I can share my screen. Give me a moment. Okay. Yes. Okay, great. Now, today's segment, really what we're going to be talking about is, right, the myth of profitable stocks, right? So how do you actually profit from stocks using financial data? So this whole segment is going to run between 80 to 90 minutes, right? So at any point in time, if you guys have any questions, please post your questions below. Right? Thank you, Rebecca. All right, loud and clear. Great. I actually brought this mic along with me as I was traveling, so that I can go live with you guys, right? And you guys can hear me loud and clear. All right, so let's get started. Now I'm just curious, and from you guys who have logged in and you're watching this right now, I'm just questioning how important are financial information or profit and loss, the balance sheet and cash flow. How important is it for you at the moment in making financial decisions, right? So if you put a 10 below, means it's very, very, very important. If you put a 1, means, look, I don't know how to read it, I'm not sure, right? Or you can put a 5 because you say, look, I look at some stuff, but I don't look at other stuff, right? So on a scale of 1 to 10, how important is financial data, right? When I say financial data, I'm talking about the cash flow, the profit and loss, the balance sheet, right? How important are these numbers in making your financial decisions, right? Because we're all about informed investing, right? So I got a 10 here, right? 5, okay. Now, what I'm hoping to do is those guys are 8, 7, or 5 and below, right? I'm trying to see this session if I can really help you simplify the whole balance sheet, P&L, and a cash flow statement, and how do you combine all of them together, right? As you know, financial data is historical in nature, right? So therefore, you're not going to see any forward numbers, right? Purely looking at financial data. However, even being historical, they are actually very, very valuable to an investor, right? So I'm a value investor. So if you're a value investor, this is probably like 101, right, that you need to know. And today's session, I'm going to give you a few examples, what they look like. Of course, this is a webinar session, and I don't have a whiteboard to write, but I want you guys to walk away with something very simple, something that you can apply, and really something you can do in a couple of minutes before you buy your stock, right? Now, I can tell you that the second reason why you want to do this is actually all about risk, right? If you're buying stocks without looking at the financial numbers, I can almost guarantee you don't know how risky or how little risk or how much risk these stocks actually carry. Okay, and I'm going to show you again, how to size up that risk. All right. So let's get started. So again, any questions? Those who just joined us, send us a text below, right? So I can see a lot of you guys find it quite interesting. So I get some 3s. I get a lot of 10s. I got a 5. Get a +5, right? So I hope to convert you guys to be able to do this much easier. Okay. Now this is a very quick disclaimer. This is not financial advice. Okay. This session that I'll be running is purely educational. It is meant for you guys to become better informed investors, right? And this is by no means any financial advice. What I've done is actually in this presentation, I have actually deliberately left out company names, right? And you'll see why I've done it as we go along. Okay, so stick to the end. You're gonna see some pretty interesting fact-finding numbers, right? Okay. So just to cover really what we're going to be doing. So we're going to break up the financial numbers. I'm going to show you very quickly how you can read them, okay? And how is it actually going to fulfill your personal investment goals, right? So the third part is where at the end, I'm going to show you how to really link it all back together. Because if it's historical, how does it link back to my personal investment goals, all right? Now, so I have to start with this, Buffett shared this quote back in 2004, I believe, or 2014. This was shared on CNBC, actually, right? And there were 3 pointers that I wanted to pull out, to share, right? Now, accounting, to most of us who actually maybe did accounting in high school, or maybe in your Form 6, or even in university, if you don't use it every day, it's likely that you may have forgotten how to use it. Okay, it's likely, right? Myself, I'm an accountant by training, right? Meaning that I did accounting university, but I can tell you, going through all that, although I could prepare accounting statements, after the many years, I could still not very confidently interpret what it means, right? And today's session is about interpretation of the financial numbers, right? So if you look at this, so accounting is a language of business. You have to be comfortable with it as you are with your own native language to really evaluate the business. Now, the whole idea here is that, look, I know a lot of people get turned off just purely by numbers. And I'm trying to tell you guys, be a bit patient, because you are effectively learning a new language, right? So, the fastest way to learn a new language is actually to jump straight into a foreign country and then live there, because then you're effectively forced to learn. In this case, what I'm hoping that you guys will do after this session is actually look at financial statements first, or when you look at the stock first, and before you decide to buy or sell any of these, do look at the financial statements, all right? The second thing is that, you see, accounting can tell you a lot, and it can be used in many ways to deceive, right? Actually, accounting tells you a lot. Sorry, typo. I say you saw in Enron, that's what Buffett said. The other aspect of why he says you need to learn it as a language is that there are a lot of false positives, meaning that it looks positive, but it could be false, right? Especially in accounting. Now, accounting in the last 100 years has gone through multiple changes, right? And up to last year, we still get changes on how financial statements are being presented, okay? And because they keep changing, what you looked at in the same company a 10-year ago P&L and today's P&L, even though the same company doing the same business, you're going to see it's going to look very, very different because of financial standards, right? And this is really where you have to keep abreast, right? Unfortunately, it's a changing world. You know, we live in a world that's constantly changing. So you have to know about this, right? Now, the last one is that, look, he said you really have to understand what can be done with accounting when it gives you correct answers and when it gives you wrong answers. So effectively, what I hope to share with you guys today is the false positives, and probably some of the benchmarks that I see a lot of investors use, which I don't believe are used correctly. Okay, so that's what I'm hoping to do. Okay, now, so very simply, okay, there are three main financial statements. These are your tools to that you can use to your advantage. Okay, the first one I think all of you guys know is a profit and loss, or also known as an income statement. Okay, well, at Bursa, companies listed on the ACE and main market are required to produce these numbers every quarter. Okay, now the quarterly numbers will differ from the full year numbers. How? The quarterly numbers are unaudited numbers, and the full year numbers are usually audited. So audited once a year, and you got 4 quarters of P&L which are unaudited, right? But in practice, what happens is that actually, if your quarterly is more than 5% off from your audited numbers, actually company directors will get fined, companies will also get fined. So they take this quite seriously. Very rarely do we have big breaches in or big changes in quarterlies versus 1 yearly numbers, okay, or annual numbers. Now, balance sheets are also given out every quarter and every year. However, they are slightly different from the P&L. P&L is measured over a period of time. So let's say from January 1st to 31st March. That means what is your profit over this period, right? Now, they will typically report the balance sheet. Let's say it's on the 31st of March, they will disclose the balance sheet on the 31st of March, right? So it's effectively a cut-off, right? And that's really what it does. It's just a cut-off. And lastly, it is the last one is actually a cash flow statement. Now, the cash flow statement effectively is also measured over a period of time, right? So you have P&L, which is measured over a period of time, cash flow, which is measured over a period of time, and the balance sheet is a cut-off, so as at a point in time. So if you think about it, if you take a snapshot of your bank account balance every day or at the end of the quarter, that's essentially what the balance sheet does in terms of timing, right? It's as at a point in time. All right. Now, when we actually look at financial statements, what I used to think was that, you know, if you only just look at the profit and loss, let's look at the revenue, is there growth, let's look at the profit, and that should be good enough, right? Unfortunately, it's really not that easy. If you actually study accounting a bit more in depth, and I put a car here as an example, if you're only looking at the profit and loss, you're effectively only looking, say, at the engine, right? It doesn't tell you whether you even have wheels, right? That means whether the car can move or not. You're only saying, wow, this engine is good. It looks very powerful, right? It looks like it can produce. So an engine by itself is actually not going to get you from point A to B, right? Now the second part is effectively your balance sheet, right? So you need a engine. You also need a chassis, right, or the car body, right? And the third part is actually your cash flow, which is your wheels, right? You need wheels to run. If you have no tires, you cannot move, right? So effectively, when you look at the financial statements, you must look at all three at one go as one main financial statement. One main financial statement that is split into three, not three separate financial statements, right? I know I used to think that when I was preparing financial statements, they were just three, you know, because you had to do it, you had to get extra marks, right? Unfortunately, that's not how it's done. In fact, everything that you look at the financial statements are all highly interlinked. If there's a write down in the profit and loss, it's likely from your balance sheet. It may also affect your cash flow, right? If you're raising money, it may not affect your profit and loss, but it might increase your balance sheet number, and also your cash flow statement numbers will also change, right? So I just want to give you guys an idea that, look, financial statements are not individualistic. That means you just not you just don't look at one and ignore the rest. You must look at all three. And today's session, I'm going to give you guys a very brief introduction on the three points that you actually want to look at when we're talking about the profit and loss and balance sheet. All right. Now in the profit and loss, what do I actually look at? Now on on a practitioner's point of view, I'm just going to share with you some of the things that I look at. When I say look at, meaning they're just very quick key points that I want to look at. Number one, I want to look at if the revenue is growing. What does the revenue do? It actually represents whether the business, the sales are actually increasing or decreasing, right? So in this case in point currently, right, if you think about it, you know, COVID has been has come down, right? So I think a lot of people are expecting second quarter of 2019, the revenue should drop because a lot of companies were not allowed to operate, right? The second item that I do look at before net profit is actually profit before tax, right? Now, effectively, what is profit before tax? Profit before tax is if really what you're trying to measure is how much value does the business actually generate, all right, as a shareholder, how much value? Because we take revenue minus out all the costs, we get it profit before tax. Now, we have to understand that profit before tax, depending on what your tax structure looks like, tax is effectively paid after profit. Net profit is basically including tax, right? So I said, look, assuming that you didn't pay taxes, the business itself, what income does it actually generate? So this is a very important figure as well. The third figure, which you know I look at, but you know, unfortunately, I think this is something that a lot of investors look at, and you know, I don't think that it's a, how do I say, it's a very good measure of the business, right? So just gonna make sure that there's some light here. Okay, I don't think it's a very good measure of the business by itself, right? So if you look at the net profit itself, what I call this net profit is actually accountant's profit. That means how much your accountant is saying that you're making, right? Of course, this is where tax is being paid, right? Now, what is more important that comes after net profit is actually dividends, right? Which means that a company needs to make profit, otherwise it can't pay dividends. Now, it can still make a loss this year and still pay dividends. How? It can take that money out from what we call accumulated earnings or accumulated profit, right? So that numbers are all in the balance sheet figure. Now, this is really only 1/3 of the company. If you're looking at the P&L of a company, you're only seeing 1/3 of the picture. All right. Now, what does it actually look like? So I pulled out one just to give you guys an idea or get a feel, right? If you actually download, any annual report, you're going to see something like this, right? This is, I just, you know, for say argument, I just downloaded Nestle's annual report just to give you guys an idea what it looks like. You're going to see that, let me see if I can get my pointer. You're going to see that sales is right on top. Now, when you read this, you have to read the group numbers, okay? Don't read the company numbers, right? Typically, the company is really just a holding company. You want to read itself and the whole group and all its subsidiaries as well. Now, if you look at the revenue, you want to see whether it has grown year to year. That's one for sure. After the revenue minus out all the costs, this is what they call profit before tax, right? And of course, this is your tax expense. Then this is how much profit you make for the year, right? Now, this is accounting profit, right? And it looks very complex, but I can show you once you get comfortable reading it, you're gonna see, you're gonna be a lot more at ease when you look at some of these numbers here. All right. Let me just check if there's any questions. Sorry, give me a minute. Okay, all right, okay. Okay, how to identify red flags, all right? So I can see some questions coming in. All right, so let's go next. Okay, now the balance sheet figures. Okay, I'm gonna share with you what I look at. Or what I believe is actually important. The first one is very simple, cash, right? Now, why do I look at cash? Now, this is actually a bit more, me being a bit more risk adverse in the sense that cash is important because if you have no revenue for whatever reason, you want to figure out how long can your company survive if you have no cash flow coming in, right? So I look at the cash numbers, right? Or cash, or what they call cash equivalent. Okay. Now, in terms of receivables, that's another key point I look at, which means that if you sell something, right, and you don't collect it in cash, it comes under your balance sheet called receivables. Okay, which means that if you invoice someone something and they say, I'll pay you later, it goes under this thing called receivables. And this is something to watch out for. Why? Because if it goes too high, that means your receivables go too high, there is a risk that you may not be able to collect on the revenue, and potentially you may have to write down a loss. That is the risk, right? So that's on receivables. Okay. Now the third and fourth item that you want to look at here is actually your loans or your liabilities, right? Now, when I talk about this, I hope it's not too alien to you, because we think of it as a big company and it's very abstract. But essentially, it's not. All this actually even applies to us in our daily life, right? So your cash and cash equivalents is something like your current account plus your fixed deposits, right? That's how much you have, right? If let's say you, for example, it's end of the year, you work 30 days, but your company hasn't paid you yet, that comes under receivables. Okay. Your short-term loans are like your credit cards, right? You have to repay them, right, as soon as possible. And hopefully you don't leave them for too long, because they are higher interest loans. And then you have your long-term loans or your long-term liabilities, which is, say, if you have a mortgage or you have a higher purchase that's lasts more than 12 months, those are what we call long-term liabilities. So it's effectively the same, right? If you guys link it back to your own personal lives, it is no different, which means that I can actually create a profit and loss balance sheet and cash flow statement for all of you guys as well, right? Okay, so there's a question here about is too much cash not good, right? Seems that management may not know how to use the cash to grow the business. Okay, so let me see if I can put this up here. Okay, now you're right. Okay, so when you have too much cash, the company may look inefficient. Okay, I want to highlight inefficient. That means it's not very efficiently deploying capital. Okay, let me give you the reverse. The company has very little cash, and they're very good at deploying the cash, capital, right? So I think of it a little bit like insurance. What if you have a crisis for whatever reason? The question is, do you prefer efficiency or do you prefer safety? Right? There is no right answer here, unfortunately. Right? It's very much a personal call. Having too much cash, yes, inefficient, or having very little cash, very efficient, right? So that's your call, right? So for me, because I'm a bit more of a conservative investor, I say, look, having cash is always, I prefer to be inefficient than to be very efficient, right? If you look at this whole cash thing, actually came about. Bill Gates in the 90s actually mentioned that Microsoft must always have 24 months of cash in the bank, right? Of operating expenses in the bank. Now, why did he say that? He's saying that, look, in case if any of their products fail to generate revenue, and because if you look at the nature of the business, how they generated revenue was actually through the sale of their software products, right? So he's saying, look, if in case there was a flop and I can't sell anything, I need that time to actually rebuild my other product, right? And that's why he keeps 24 months of cash, right? Another very famous company like Apple or Steve Jobs never paid any dividends. He kept a lot of cash in the bank, possibly for opportunity for any M&A purchases. It was only after his demise that Apple started paying dividends, right? So there are a couple of reasons why companies do it. It may not be a good thing, may not be a bad thing, but from a safety standpoint, it's obviously safer to have more than less. Okay, because think of it as having two engines, right? Think of yourself, right? Is having too much savings a bad thing? Yeah, of course. If you had all your cash in fixed deposit, I can tell you, you're not going to be very efficiently making any money today, right? What if you took that cash today, because if you treat yourself as a company and you invested in stocks, right, and you made money, that would be a much more efficient way to do it, right? So there's no right or wrong answer here. It's really it talks about your level of comfort ultimately. All right. So I hope that answers that question, right? Now, so okay, good questions. I think those are very good questions, right? Now, what does the balance sheet look like? The balance sheet looks probably a little bit more complex, right? And you know, this is such a dry subject to talk about, but effectively, it takes your assets, which is here, assets. So assets, they turn into long-term and short-term, right? And then you have liabilities, what you owe people, long-term, short-term, and the difference between your assets and your liabilities is known as your net worth, okay? Same as yourself, for example. If you take care of yourself, you take out all your assets minus all your debt, you should look at it if your net worth is positive or negative, right? Now, if your net worth is negative for any company that net worth is negative, then we have a problem, because then they call this bankruptcy, technical bankruptcy, right? If your assets are less than your liabilities, all right? Okay, so I've got some questions here. I'll keep going. I'll do my last one, and then I'll answer a couple of slides, right? Now, cash flow, key main figures: cash flow for operations, cash flow from investing, and cash flow from financing. Those are the three main ones. I'll show you what they look like in real life. It looks even more daunting, right? If I'm a non-accountant, I look at this, the numbers look at me, I look back at them, it just freeze, right? It doesn't make sense. But if I simplify it for you, ultimately, cash flow for operating activities ultimately just means how much cash flow you get, right? Purely from your business, okay? Nothing to do with investments, nothing to do with fundraising, nothing to do with anything else. Just from your business, how much cash flow do you generate, okay? And actually, they give you this net figure, all right, at the bottom here. Now, the next one is, this is your investing and your financing activities. I've taken exactly what it looks like, and I just want to give you guys clues to where you want to look at, right? Now, cash flow from investing activities, as you can see, this actually talks about how much you invested back in your business. So if you look at this, in this case, Nestle, in the last year, they acquired property, plant, and equipment, 183 million, right? So they invested in their business. Now, the whole idea why you want to look at investment is that if your management is good and you have a good business model, the whole idea here is just like you. If you're investing in stocks, you're hoping to get a return, right? Of course, this is the same thing, but they're not investing in stocks, they're investing in their own company instead. So if they know their business and they know where to deploy capital, these are the clues where you get to see how much investments that they made, right? Now, lastly, financing activities can be borrowings, could be you paying back your loan, it could be you your company raising money. So all that is captured in these three numbers, all right? So cash flow from operations, investing, and financing, right? After this, I'm going to show you guys how you're going to see the growth from it, right? Now, let me see. Let me answer some questions here, right? Okay. How would you evaluate a company that invests and develop in startup incubators? I guess the question here is, how much are they investing in? All right. Obviously, I believe a lot of these companies now is being quite popular. They're saying that, look, if I'm looking at my current existing organization, and here if you look at the stock categories here, if, for example, I'm in investment grade stock, I'm in a good business, I'm making profits, right? And I'm the CEO, and I realize, look, my culture right now does not actually promote creativity, right? So how do I do it? Is there another way I can outsource creativity, right? So there are a lot of these guys who are running startups, smart guys, smart or not so smart guys running startups, right? And I guess the whole idea here is when you invest in incubators or looking at startup companies, you're hoping that you invest in them, that they could also give you better returns, right? So I guess or how you can use or partner with them to actually make your own business better. So I think this is getting quite popular now. But I guess the question here is how much, right? If I had 10 million and I'm putting 9 million in incubators, then we need to figure out what's wrong with your existing business, right? Or is the investment so sexy that that is something that you cannot give up on, right? So I guess the question is magnitude. How big of amount? Okay. Yeah. Okay. So when you look at this is what I call a business life cycle, right? If I look at how I would grade stocks, right? Or any businesses, think of any businesses, right? All businesses will start at the bottom. They're called startups, right? Exactly like the question you asked me earlier. you started here, and what happens is that if your business actually picks up momentum, it'll move into what we call emerging grade, right? After it moves into emerging grade, that means your business model is starting to grow, it's starting to work, you're starting to scale up, right? That's emerging, right? Now, investment grade is typically your business model has grown, very matured. Scaling becomes a little bit more difficult, right? And you're very consistent. You make profits, you pay dividends, you've got cash flow, you've got free cash flow, right? You reach the pinnacle, right? And then of course, a lot of good businesses come down as well on what we call sunset or turnaround companies, right? So sunset means you're on the way down, but turnaround means that turnaround with a question mark here, it means that the question is come down, is it possibly for it to go back up again, right? That's why if I put here, I put this out as turnaround, okay? And actually today, I'm going to give you guys some examples, what they look like. Your financial statements will give you some clues into sort of where they sit, okay? Your financial numbers will give you a clue. But of course, you need to understand what business they're in as well, which is very, very important. You need to understand the business they're in. You need to understand the context of the business, which is the most critical part, okay? So I've got some questions here. Where do I get info for a company I've not yet invested? Okay. Now, actually, financial numbers are all publicly available. So you can actually go to 𝗍𝗿malaysia.com. You can actually go and download financial numbers, of course. There are many, many sites out there that you can actually get financial data, right? You could also go, 𝗍𝗿 has a free website called 𝗍𝗿 Marketplace. You could also go there, Google it. You can get quite a lot of free information out there. And they give you the same thing, balance sheet, profit, loss, P&L, all right? Okay, let me see. This is a good question, right? In Kong, right? How do you do fundamental analysis of a startup with a potential to be a unicorn, but no, you can't. It's hard, right? It's all based on projections. Remember, financial data is historical. So if you have no history, it's impossible to do any sort of financial analysis on it, right? So that's why a lot of VCs or angel investors, they'll look at a few things, right? They'll look at the size of the market. What's the size of the market? It's a little bit more. That's why they talk about startup or newly listed companies. It carries more risk because there's a lot more uncertainty, right? Because there's no track record. So you look at the market size. You assess management, can they stick together? You look at the skill set, you look at the product, right? And possibly you might want to do a trial to see whether people like it, right? And see from then whether they can scale up. But it's very difficult to ascertain from a startup point of view when there is no financial data. It is almost a very good educated guess, okay? If someone said that, I invested in Amazon because that I knew it was going to be a unicorn, right? At that point in time, with whatever information, it's like the first year of Amazon running, it's the vision, right? And the management and the long-term trend, right? There won't be any data or hard data to back you up to tell you that yes, you are definitely going to be a unicorn, unfortunately, right? So tricky. Not using financial data, you won't get there. Okay. Okay, I'm gonna on request on very specific stocks. We might have to have another session, but this is purely an educational session first, all right? Now let me go next. Okay, so we've talked about profit, loss, cash flow, and the balance sheet, right? Those three very, very big numbers, and I've told you guys that it is one financial statement, not three. Okay, now let me explain to you how I mean, it's a very simple way to explain it. Your profit and loss basically tells you the health of your company, health, right? Which means that a company may look healthy or someone might look healthy, but unless you actually do a blood test or you do an x-ray, you won't really know they're healthy, right? So this is why you need cash flow. Cash flow actually shows you the condition of what you look like. So someone might look healthy, but you can't tell if they're diabetic or they have high blood pressure unless you do the blood test, right? So we always use the cash flow statement to test that. And lastly, your balance sheet is actually your wealth, right? So one is your health, one is your wealth, one is to ready to test your health, whether it's in good condition or not. So I'm going to be using these three analogies, right, to actually explain to you when we look at different types of stocks, what they kind of look like. So health, condition, and wealth, okay? And I'll tell you very specifically what I'm going to, some of the financial numbers I use to determine health, condition, and also wealth, all right? So like I said, this is a very simple sort of introductory session. Of course, when I cover financial statements, I take normally a day and a half to really fully understand financial statements, right? But because it's an 80, 90-minute session, I'm just going to focus and hope that you guys can take some away, all right? Okay. Now, so for health, how I'm going to measure health of a company, right? I will look at the net profit, okay? So that's covered in their profit and loss statement. So I'll look at the profit to see whether your company is healthy. 1 point only. I'm just using 1 point. Second one, for condition, I just want to know if your business cash flow is healthy or not. So I use it as condition. All right. Now, in terms of wealth, all right, I just want to look at how much cash they have versus the debt that they have. Right, so cash versus the debt, right? So you got cash versus debt. So 3 financial statements, 3 points, right? Now, of course, because it's a very simple introductory portion, of course, there are many other aspects that we can look at. But if you can use these 3, they will more or less give you an idea what business they are in, okay? Or where they sit, actually. Okay. So I think we have one question here. Let me just answer this very quickly. This from Jason Bowie. I said, yeah, I remember a session with Dato' 𝗠𝘆𝘁𝗵𝗀 that he evaluates REITs based on net asset value per unit. Is there a different way of evaluating REITs? You're right. What I'm showing you is actually for normal businesses. Now, effectively, a REIT is a property manager, right? So a REIT basically will collect funds and they will invest in property. What happens when they get rental from those properties? They will give it back to the unit holders, right? Not so much shareholders, because it's effectively a trust, right? Or trust structure. So what happens when you do look at REITs? You need to look at their net asset value, because essentially their business is holding assets, right? So you want to see if the share price versus the asset value. Unfortunately, in stocks, it's not so simple. Okay, in stocks, a lot of people say, let's use NTA, right? Or net tangible asset, which is the wealth part. And I'll show you when you purely only focus on 1 out of 3, what can happen as well. I've actually got some examples in the later slides. I'll show you guys, right? So I hope that happens. I hope that answers your question. Now this is another good question. What if CapEx is higher than operating cash flow? Okay, very simple. So if you invest more than what your business takes in, and I must tell you, this is quite normal, right? Especially if you're growing, this can be quite normal. So in the sense that you're asking me about this, right? So I'm going to show you, come back here. You're essentially saying that if investing cash flow is more than cash flow from operations, so it means you're investing more, which is a negative. If your cash flow from operations is positive, right? What happens means that at some point that number needs to come back together. So for example, if you make 100 million in cash flow from your business, but you want to invest 300 million. So where do you find the 200 million? Okay, 200 million can come from 2 ways. Number one, the easiest one is you finance it, right? So your cash flow from financing activities will be positive 200 million, for example. Another way you can finance it is actually going to be on your balance sheet, which is your cash and cash equivalents. There's really only 2 ways, right? The whole idea you want to invest, right, is that over time you hope that your revenue goes up and your net profit goes up and your dividend also goes up, right? But it is normal if your capital expenditure is higher than your operating cash flow. Okay, that's where we come in this situation where you have negative free cash flow. So a lot of companies, they are in a startup mode or they are starting to grow their business. Typically, they are in the negative free cash flow mode, right? It is quite normal. All right. So those are good questions. Keep them coming. Now, so what I've done with this, right? Health, wealth, condition. So with these three, for example, I'm going to give you guys an example. I can have a healthy company with a good condition, but very poor wealth, for example, not wealthy, right? That's one scenario. I can have not healthy, good condition, good wealth, right? Or I can have healthy, poor condition, good wealth as well. So if you look at these three variables as financial numbers, you are actually going to get 9 different types of companies or 9 possible outcomes, right? And what I'm actually going to do here today to give you guys an idea on the 9 possible outcomes, where they will actually sit in terms of the life cycle of a business. I will also be talking about value traps, and I'll also be I'll be covering what we call overlooked or unloved companies, right? Or misunderstood companies, right? So using these 3 financial statements, being health, wealth, condition, if you take each of them individually, you multiply them, there are 9 possibilities that you're going to come up with, right? And I'm going to go through all 9 possibilities, and which are what I call investable or not investable. All right. So remember, health, I'm going to use net profit. Condition, I'm going to use cash flow. So if it's a good condition, means positive operating cash flow. If it's bad condition, means negative operating cash flow. That means you don't generate cash from your business. That means you suck money out from your business. That means you have to be funded somehow. And third one is your cash versus your debt. Okay, how wealthy you are. So just remember these 3, and I am trying to simplify this whole process so that you guys can take home and something good to take home with. Now let me give you for the first scenario here. You are healthy, you are wealthy, and it's good condition, right? Is it investable? Yeah, of course, right? This is how financial statements are good for you, right? If you're healthy, that means you look healthy, but you're not wealthy, and you've got bad cash flow. Is it investable? In my opinion, no. All right. If you look at the profit and loss, again, if it's healthy and wealthy, but your cash flow is poor condition, I would also avoid those. All right. If you look at healthy for profit and loss, not wealthy for balance sheet, but you've got good cash flow, I like those companies, right? That's okay, right? But you want to, at least when you look at these numbers, you want to know, hey, is my P&L healthy? Is my balance sheet wealthy, not wealthy? Is my cash flow in good or bad condition, right? And I did it very simply, you can size up your company here, okay? Of course, real or actual deeper financial analysis is required when you do this, but I just want to give you guys a flavor of what it should look like, all right? The fifth one could be you're not healthy, but you're wealthy and it's good condition, right? That's also something that I will invest in. You're not healthy, not wealthy, poor condition, I would avoid. If you're not healthy, but wealthy but poor condition, I also avoid. Healthy, not wealthy, but good condition, I would still take it, right? But number 8 is going to be very, very rare, okay? In fact, I'm going to give you guys live examples, exactly what I mean when I say healthy, wealthy condition, right? And the last one is healthy, not wealthy, poor condition, I would avoid, okay? So let me go through first one, right? What do I consider investment grade? Investment grade can be 2 things. They need to be both healthy, but the balance sheet, they can be wealthy or not wealthy is also okay. But very importantly, they need to have good cash flow. And I said good operating cash flow. All right. So if you look at this, this is how I would define it. So I want to give you guys some examples. Now, this is a big disclaimer. I'm actually going to be covering stocks, so I'm not asking you guys to buy, sell, or do anything of these stocks. In fact, I have, by design, actually taken out the company names. I've also shown you the share price as well, right? But I've taken out the company names, because this is my personal opinion, and I don't want you guys to guess what it is. But in my opinion, this is what I think they sit in. Okay. So what does an investment grade stock looks like? Okay, if you look at this here, Now you have to look at financial numbers over a period of time. You cannot just use 1 year and say, yes, I've got a story, right? You actually don't have a story if you only use it for if you only do it for 1 year, right? You must at least do it for 3 years to 5 years, right? So in this case here, I pulled out some numbers. This company's turnover is growing slowly, right? It's also profitable, right? So in this case, I will consider this company healthy. Okay, healthy, yeah? All right, simple enough. Now, what about this? This is your balance sheet, okay? If you look at your balance sheet here, this company, I wouldn't say is wealthy, because why? If I look at my cash versus my short-term loan and my long-term liabilities, 10 million versus 600 million, right? 7 million versus 600 million, 12 million versus 600 million. Big gap, right? So they don't have a lot of cash. They actually have more debt than actually have cash. So I would call it healthy, but not wealthy. All right. Now let's look at the cash flow. If you look at the cash flow here, the operating cash flow, the cash flow is actually very, very healthy, 700 over million a year, right? So this is healthy, not wealthy, but very good condition. Okay, so when you actually do this, right? Let me give you an idea this is what the share price looks like. Okay, so this is why I say call it investment grade stock. So an investment grade stock does not need to be wealthy. It just needs to be healthy, and it must have good condition. All right. Let me see some of the questions that. Okay. Okay. Now, this is a very good question here. Now, when we look at financial statements, unfortunately, for different sectors, different methodologies will apply, right? You are right, exactly. These numbers I'm showing you is for any businesses that are not in the financial industry. So, for example, banks, credits, or insurance, there's going to be a different way where you need to analyze some of these companies, right? So, for example, you're right, for insurance companies, because they take your premium and they reinvest it, right? And that's part of the business, right? So if you think about it, that's why insurance companies are very, very old, and in fact they were one of the very first, I would say, setups for long-term value investing. They were really, really very much set up for long-term value investing, and that's why Buffett loves insurance companies so much, because they say, look, you take the premium, or you take whatever net premium you get. It's literally free cash every month or every day. You get free cash, and whatever you don't have to pay out, you invest it, right? And that's why insurance businesses are very well suited for long-term investments, right? And that's why if you look at very big insurers, they are typically 100 years old or at least 50, 60 years old, right? Because they have that time frame. All right, to give you guys an idea. Okay. Okay, so by good cash flow, what do you mean? 6 months of cash to finance operating expenses, or okay, so when I say good cash flow, I actually mean that, so these numbers that I'm showing you here, these are cash flow from operations over a period of 1 year, which means that whatever income or cash it receives minus whatever it has to pay out in cost, raw materials, salary, EPF, anything that leases, whatever you have to pay off, net, this is what you get. So if you think about it, what is good cash flow management for you personally? Whatever income you earn every month, less whatever you have to spend on yourself, just on yourself, or your family, just living expenses. This does not include paying off your mortgage or your car, anything else, right? Just whatever you need to live, right? Basic expenses, whatever income you take minus your basic expenses, it should be positive. All right, that's what I mean by operating activities. All right, of course, it includes the interest or rental. If you live in rent, if you're renting, it includes your rental or any expenses that you incur. Right. So imagine this: how bad would it be if whatever income you get every month, you spend more than what your monthly income? That's going to be pretty bad, right? So it's the same for a company. It is exactly the same. Nothing else changes, right? So that's what I mean by having good cash flow. So I got some good questions here. I purposely left out some companies here because I don't want to seem as giving financial advice. You guys can guess what it is. I purposely by design, but I want to give you guys an idea. Don't worry about what company they are. Look at the financial numbers instead. All right. Okay, so I hope I answered some of those questions. So remember health, wealth, condition. 3 things only. Okay, I want you guys to just walk away. Remember health, wealth, condition. I want you guys to also remember that you need 3 financial statements to actually make a good call on a company. All right. Okay. So I'm giving you another one here. This is healthy, very healthy. So if you look at the profit, they make profit every single year. Okay, now I normally use 3, 5 to 10 years to look at, but I couldn't fit 10 years of data into one slide, so it looks a bit weird. So I kind of zoomed in, but just give you guys a feel about what I mean by profitable, right? So this company has been continuously profitable for the last 20 years actually, or more than 15 years. It's continuously profitable, right? So that gives me a very good indication whether it's a good company or not. So number one is healthy. It looks healthy. It says it makes a profit. Now, is it wealthy? Okay, now if you look at this company is very wealthy, right? Because it has something like 200 million in the bank and 1 million that they owe people, right? So they got 100 million in the bank, they owe 1 million, 136 million in the bank, they owe 1 million, right? So this company is not only healthy, it is also wealthy as well. All right. Again, the argument is, maybe, they're not very efficiently using their cash, right? That's fine. But I'm okay with both. But you just need to put it into context and what we mean by healthy and wealthy. All right. Now, let's look at the cash flow here, right? Now, in terms of cash flow, this is actually also good condition because every single year they've got positive operating cash flow, right? Every single year they got positive operating cash flow. And it's essentially that's what you want, right? So healthy, wealthy, and good condition as well, right? So this is 2 examples of what I mean by a investment grade company, all right? So this is what the same company, the share price will look like. So healthy, wealthy, and good condition as well. All right. Now, let's talk about emerging grade. Okay. I'm going to be talking about few, right? So I just want to give you guys an idea what they look like. Emerging grade can be 2 things. They can be healthy. The balance sheet may not be wealthy or can be wealthy. It doesn't matter. But the cash flow should be in good condition, right? So it's almost similar to your investment grade stocks. So I'm going to show you guys what I mean here, okay? So I've actually spotted one. I should give you guys an idea of a company, right? So if you look at 2014, 15, 16, if you can see, if you notice, their profits actually have been growing up, right? So really, if you look at profits going up, you're saying, look, this is getting healthier, right? In fact, its sales is also going up. So on just purely looking at the financial statements, the P&L, is it healthy? Yes, it's healthy. All right. Now, how about the second one here, right? Is it wealthy, right? Okay. Now, in 2014, it wasn't exactly very wealthy. Okay. He had 40 million in cash and about 37 million in short-term loan and long-term loan, right? Then he started building up his cash, 25 to 24 almost, right? And it kind of completely flipped from 46 to 14 million, right? So you can see this company started becoming healthy and wealthier, right? And of course, if you look at this area here, it's getting healthier and healthier because its cash flow is still 41 million and its short-term loan and long-term liability is only 17 million. So it's getting healthier. It's also getting wealthier over time, right? Now let's look at the cash flow, right? Its cash flow is also improving, right? 12 million, 31 million, 46 million. So last 6 years is continuously profitable in terms of cash flow. It doesn't have issue collecting cash, right? So this company is not only healthy, wealthy, it's healthy, it was becoming wealthier, right? And then it has also good condition in terms of the cash flow statement, right? So you're gonna see sort of differences between all of them, right? Of course, if you look at the share price, this is what the share price looks like, right? So if I did 5-year share prices because this is what we're doing. All the share prices I'm sharing you are all 5 years, all right? And you can sort of see where we are at just looking at some of the share prices, right? So healthy, wealthy, and condition, right? All right. Now, now just now someone asked me the question about startup. Hang on, let me try and answer one question here. All right. So this question here is intangible assets, right? Do we need to exclude from the calculation on the balance sheet? Okay, if you are looking at the wealth of the balance sheet, okay, typically the question is depending what the intangible asset is. If the intangible asset is only cash, right? If it's only goodwill, then it might be a good idea to discount it, right? So if you look at wealth only, that means net tangible asset, you take out intangibles, then yes, you will take out intangible assets from the balance sheet. All right. Okay, keep the questions coming, right? I hope you guys are following. If you are following, just put a comment or thumbs up or give us a like or some love, right? If you're finding these sessions useful, all right. That's kind of weird. I'm just speaking to myself, right? But yeah, so if you're following what we're trying to say, I think that this is and you find this easy enough to understand, that's really my job, right? I hope to impart some of this knowledge over. Now, in the case of startups, there are a few startups, right? So if you're at the very early stage and you're experimenting, like someone asked me earlier, yeah, it's not healthy. It's not going to be healthy. Your profit and loss is not going to look good because you're growing that business. Your balance sheet is not going to look good, right? Because you're constantly always trying to raise money. Your cash flow also might not be good because your product may not be out there or you could market it anyway, right? That's the first one, right? The second one is maybe if you're a later stage of a startup and you are starting to grow, right? So you could still be healthy, but you may not be wealthy because think of a young person, right? Young person just starting work, a lot of energy, can grow and earn more over time. They're healthy, not necessarily wealthy, but they're in good condition to keep going on, right? So really, that's the idea of a startup, right? So like someone really earlier mentioned, startups, you don't have a lot of financial data to back you up, all right? Now, what's the opposite end of a startup, okay? It's actually a sunset, okay? How do you spot them? Sunsets are the easiest to spot. Not healthy, not wealthy, poor condition, not healthy, can be wealthy, not healthy, but can be wealthy. And good condition. Now, what do I mean by this, right? If you look at some of the companies that actually have, if you look at the companies that have gone sunset, like Kodak or Nokia, right? When they were getting into a sunset business, or even BlackBerry, right? Used to become Research in Motion, right? RIM, right? If you guys look at this, right? Look at some of these companies. At that point, there were analysts calling and saying that, look, this is still a great company, right? Because its profit and loss was not looking good. Its cash flow was horrible, right? But it's slowly starting to shrink, but it still had a lot of cash on the balance sheet, okay? And I'm going to share with you what they kind of look like and why they are also known as value traps, right? When I see a lot of newbie investors, they come in and say, look, the share price is below a net tangible asset, therefore I can buy, right? Typically those are value traps because they are only focusing on one aspect of the financial statement, but not all three, right? But all three needs to give you one picture. Ultimately, that's really what it's meant to do, okay? So let me go back here. Okay, so I'm going to give you guys some sunset examples. Of course, I masked some of the names out on purpose, okay? But if you look at it, the company looks healthy, right? Growing revenue, net profit is great, right? But let's look at what happened to its cash flow. Its cash flow is negative for 1, 2, 3, 4, 5 years continuously, right? And it's been sustaining itself by actually borrowing money. That's why it's been positive here. If you can see here, right? So what really happened here? So you've got looks healthy, condition is bad, right? And Not very wealthy, 10 million, 88 million in loans, 6 million, 100 million in loans, 22 million, 200 million in loans, 40 million, 381 in loans, right? So if you kind of can paint that picture, it's healthy, poor condition, and not wealthy. Okay. Actually, I don't have to share with you what happened to the share price. It's actually zero, has been delisted. Okay. But really, just give you guys an idea, right? This is what happens, right? So don't fall in the trap of only looking at one financial statement and saying, yeah, I should go and buy this share, right? This company eventually collapsed and shut, so it's no longer listed, and that's why you can see I'm using 2008 2009 numbers, right? I purposely marked out the 2009 number because the loss is even bigger, but at that point in time, if you have received that financial statement, it's too late, so it's no difference. But what you want to know is you want to catch this. And the share price was going up. Unfortunately, that was really what happened. Share price went up and it came back all the way down, right? So if you looked at the last year, waited for last year before it got delisted, you would have lost a lot of money. What you want to catch them was before that fall, right? And that's really how you can catch them. Healthy, poor condition, not wealthy. All right. So I think that's kind of clear indicator, right? Of course, if you guys have any questions, feel free, send them over. All right. Okay, so okay, how much operating income should increase year to year for emerging grade? I think that's a great question. Number one, I love for it to grow every single year, but sometimes it's not so straightforward, right? Businesses, depending on economic environment and climate and so on and so forth, right? If anything is growing at double-digit growth every single year, I will consider very high growth, right? 20% and above, right? You got fairly, if you're consistently growing at 20% or 15%, that's very, very, very decent growth, right? Because ultimately you hope that will translate into the share price. I mean, if your share price increase 15% a year, effectively in 5 years you would have doubled. Your share price would have doubled in 5 years, right? Which still beats 3% FD. Okay. So anything double-digit growth. Now, not just on a year-to-year basis, you can also compare it quarter-to-quarter basis. So, like when you're doing quarter comparison, don't forget to compare Q1 this year to Q1 last year, for example, right? Of course, if you want to compare any quarters this year, I can almost tell you it's going to look really much worse than last year, right? So you want to use that to actually compare, right? Anything double-digit or high double digits are really, really exceptional, all right? Okay, so let me give you some ideas of a turnaround, right? So this company is now, when you come to turnaround companies, it gets a little trickier, okay? Because you can't just depend on the financial statements. Only financial statements will only give you half the story. You actually need to look at the actual business that's running, right? So you got to make sure that works as well. So what is important, not just financial statements, is actually context to the business, right? What business are they in? What are they promising that they will turn around? Okay. I guess a very famous case about turnaround that is in the public arena that is quite well known is MAS, right? Malaysia Airlines has been trying to turn around for a long time. They've had 3-4 new CEOs that have come in to try and turn the airline around. So you need to know what are they doing differently to turn this business around. Obviously, if it's the same business, it's going to be quite tough, right? So in this case, you can see this company was earlier profitable before, and then even though it increased sales, it's actually lost money, right? So these are kind of examples of what we call turnaround companies. So they are in a negative, so they were positive position, then it became negative, right? The question is, can they come back up to positive again, right? So if you look at this, it doesn't look very healthy in the last 2 years, right? But in terms of condition, they are not doing too bad, right? If you look at the condition, they are still cash flow positive 3 out of the last 4 years here, right? So even when they did lose money in terms of net profit, right, they were actually still cash flow positive, right? Now most of us will probably get confused. How can a company lose money and still have positive operating cash flow? It is very, very normal, by the way, because accounting is actually measured based on accrual accounting. That means it's transactional based, right? And it's done by accountant. Cash flow is actually really measures the real cash in and out of the business, right? So as a business owner, cash flow is actually more important than your net profit. All right. Okay. So that's the whole idea here. Okay. Now let's look at the turnaround examples here. So if you look at this, this company is a turnaround, right? It's lost money, but it's actually got cash flow, right? So not so healthy, but its condition is good condition, right? It's also quite wealthy, because if you look at the cash over their loans, they actually got more cash than they have in debt, right? So really what you're looking at is they're actually in what you call a net cash position. So you have wealthy, not so healthy, but good condition, right? So these are potentially what I call turnaround companies, all right? Potentially, okay? Let me see some questions here. Yeah, okay. Okay, I think this was probably a reply to someone else's question, right? Okay, cool. Now, so if you look at this, this what can happen to the share price, right? But of course, you got to figure out what is exactly the scenario that's happening, right? These are all real examples, and I've just taken out the company names, but just to give an idea what potentially turnaround can come to, right? So this is what I call a safer turnaround in a wealthy, good condition, but not so healthy. Okay, so the question is, can they turn this business around? All right. Now, if I go to the next one, now this is what I call value traps. And I see them very, very often, right? Value traps. Have I fallen into a value trap before? Yes, I have. I've fallen into a value trap before. And this is where I'm hoping to share with you guys, not to fall into a value trap, right? Typically, value traps will look like this. They don't look very healthy, but they are very wealthy. Okay, a lot of money, like, so typically a lot of cash, a lot of land bank, a lot of everything lah. The balance sheet looks fantastic, okay? But their actual business is not doing too well, right? That means they also possibly don't even have cash flow as well, right? So what happened here is this, right? If you look at this business here, the sales is coming down. The sales is coming down, right? It is profitable, but it's not very profitable, right? It's 5 million, right? And the revenue has dropped quite significantly, 300 million here. Okay. Now its cash flow is okay, so its cash flow is decent, right? But the growth is actually coming down, right? So a bit of a sunset, right? And it's quite significant. If you look at the fall, it's quite significant. They still generate positive cash, which is okay, right? What you're gonna also find is that they are also incredibly wealthy as well, right? So they've got a lot of cash, right? Pay a lot of dividends. Everyone's chasing this, these kind of companies. Oh, a lot of money. They'll pay special dividends and all. But understand that at the end of the day, when you're buying a business, you're buying it for its cash flow, not so much its cash today. Okay, if you're buying for its cash today, then that I won't call it considered very value investing, like because when we buy stocks, we're buying a business, right? We're not just buying its assets. So if you remember very early on, if you look at sorry, I lost my train of thought. I see a lot of cash-rich companies or companies with a lot of land bank, and normally the value trap works like this. The price is $1, the asset price is $5, or therefore it's worth it. Those are major value traps. I never subscribe to those anymore. That's when you only focus on wealth, but you forget about the health and you forget about condition. And I think, like someone just mentioned, right, whether their business can grow sustainably or not, and that's going to be a tough call, right? But don't get attracted to these companies, because this is the surest way, number one, to lose money. But it actually teaches you something, patience, right? And your patience got to be very, 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 very patient, because sometimes these value traps will never actually realize in value itself. Okay, not in share price, not in dividend, nothing. Typically, most of the time, why? Because the controlling shareholders will not let it go anyway. All right, but just to give you guys an idea what I mean by value traps. Okay, so you can see this in this particular case, this is the share price for a value trap, right? Because there's no revenue, there's no cash flow coming on, so there's no growth, right? So you can't just buy it on the asset value, right? Now this is what I call speculative. Okay, speculative can be a few ways. It can look healthy, it can look wealthy, but it's got poor cash condition. That's one. It may not look healthy, it may not look wealthy, and it's very, very poor condition. Okay, now what do I mean by speculative? That means the share price has gone up despite these numbers showing not healthy, not wealthy, poor condition, right? It could also be healthy, not wealthy, and poor condition as well, right? So all three of them, if the prices go up over time and with no reason, these prices are going to be there short term only, right? If you don't have any of these numbers here, if you ask me, this is kind of speculative. All right, so I want to show you guys what I mean. So this is a company that revenues dropped significantly, they've lost money every single year, doesn't look healthy. Definitely got no cash flow, no operating cash flow. If you look at this, -8, -5, -6, -3. Okay, and then they're wealthy because they have cash. They got new cash injection, 50 million, and no debt, right? So wealthy, not healthy, poor condition, right? And you see a spike like this, right? How do you explain it? Okay, surely it has to be speculative in nature, right? Because it's got no revenue, it's only got wealth on the balance sheet, right? Okay, I'll show you another example here. Again, the company loses money every single year. 6 million minus 3 million. Okay, no cash flow. In fact, a cash bleed for many years, except last year, right? They've got cash again. They've got cash to sustain themselves, surprisingly, right? So 14 million over 2 million. So they're wealthy in a certain extent. Okay, and you see another spike like this, right? So you have to be very careful when we look at some of these companies here, when we're talking about speculative examples. So health poor, condition poor, only wealthy. All right, and this is where I call it a bit speculative, right? So if you're banking purely on the wealth part, it's very much speculative, or actually what I call a value trap. All right. Now this is the last one that I have here. Stay to the end. I got something to share with you guys, right? If you look at this, these are what I call overlooked or misunderstood stocks. Okay, overlooked or misunderstood. What happens here? It is not healthy. It is wealthy and it's good condition, right? I like these stocks, right? Or they're not wealthy, not healthy, not wealthy, but good condition. That means it's only cash flow, right? So I want to show you guys what I mean by this. If you look at this company looks like it's not healthy, right? The profits keep coming down. All right. In fact, the revenue has also fallen a bit, but profits keep coming down. But when you actually look at the condition is still okay, right? Every year they still got positive operating cash flow. In fact, very good positive operating cash flow here as well. And in fact, if you look at the wealth, they are wealthy. They got more cash over the total debt that they have here. So this company doesn't look healthy in a sense, but it is wealthy and it's also good condition, right? These are what I call overlooked or misunderstood stocks, right? They're misunderstood because most investors only look at profit, but they don't look at cash flow, and they don't look at the wealth of the company, right? So these are companies that if the share prices come down, I'll be very happy to look at them because possibly there is a price and value divergence, right? But just to give you guys an idea, this is really what it looks like. Okay. Yeah. So if you guys have any questions, happy to just keep posting them. I'm happy to answer them here. This is a very quick one. 𝗍𝗁 Malaysia now has a 𝗍𝗁 Academy now. In fact, this video will be also on 𝗍𝗁 Academy, which is 𝗍𝗁academy.𝗍𝗁 Marketplace.com. So go and check it out. This is a new initiative by 𝗍𝗁 Malaysia. It's absolutely free for you. So do check it out. Now, before we kind of enter the Q&A, we very much appreciate it if you guys can go to this link here. We'll post the link here. If you can give feedback on today's session, whether you liked it, you didn't like it, or what you think can be improved from it, as usual. So if you can share, if you click on the link below, or actually or type this into your URL now, to give us feedback on whether you found it helpful or not, this session, right? So if you guys have any questions, we are happy. I'm very happy to answer any Q&A you guys have on today's session. Right. So I think this is a good question here. Speculative ? Manipulated ? Promoted ? Those are all very fine lines, right? Actually, if you look at this, it could be any of the three here, right? It could be any of the three here. So you're right. So when they have no fundamentals and the price move up for no reason, you just got to be very wary about it. Okay, it has to be. So you notice the two examples where the share price went up. One didn't look healthy, but the condition was still good, and it was wealthy. Okay, the other rest doesn't look healthy, poor condition, but only wealthy, right? And the share price went up 5 to 6 times, right? So you must obviously take note of this, right? So these are the 3 simple steps. I think that if you guys use this, very quickly you can size up a company. Now, of course, you can't just use one financial number anymore. If you realize it, you actually should use a combination of the 3, and you must look at it over a period of time. Okay. Saying the company is misunderstood. Well, you have to go and check out the financials and see whether you see, is it healthy, good condition, and wealthy or not. Okay. I believe its health looks okay. The condition is condition is fair, but I don't believe it's very wealthy. All right. And of course, when you are hit with a drop in oil prices, or if your business is affected, especially from things that you cannot control, therefore it might affect the wealth, right? Now remember the wealth part. If your business doesn't do well and you got a lot of debt, you're gonna begin to some serious problems. All right. So if you've got a lot more debt than you actually have cash to sustain operations, and a downturn in the business, you're walking on very thin ice effectively. So you can look healthy, you got good condition, but if you're not wealthy and your business is not very sustainable, then there is possibly an issue as well. I'm not saying specifically for Sapura, but I'm just saying you must look at these 3 pointers here. Okay. Okay, so another Q&A. How can investors take advantage of the latest change in triggering the circuit breaker? I don't think there's any advantages or disadvantages here. I think what the exchange is trying to do and the regulators are trying to do is, you realize the circuit breaker is more for down than up, right? Because the market is getting volatile because of obviously what is happening today. But it's not stopping going up, but it's actually stopping coming down. So really, I don't think there's neither advantage or disadvantage. They just don't want to see such sharp spikes before the investors can do anything. All right. So I hope that answers your question, Jason. Yep. So I'll be very appreciative if you guys can go to the link and give us feedback, what you like, what you didn't like. Whether if you like to see us back here again, right? You don't like to see us back, we'll still be back next week, next Saturday, right? With another session brought to you by 𝗏𝗏 Malaysia. Okay, good question here. If the company is wealthy and if the company is taken private, the price would be more than, well, I guess the question here is at what price they're taking it private, okay? And that seems to be a bit of a stickler here because they need a third party to advise whether the price that's being offered is fair or not fair, right? But the word fair is actually, big question mark. Fair to who, right? Fair to the buyer or fair to the seller, right? So if you look at being taken private, if you want to look at the wealthy part, you must look at obviously the net tangible asset or how much cash they have. There has been cases where, that's why I call them value traps, where companies are taken private even below what their balance sheet offers, right? So which means they get the business for free. And that's why I try to stay away from these speculative things that, oh, this company is so wealthy, it's got this, got that, therefore I'm going to make money. Chances are, if you already know that, everyone will know that as well. But not more than often, these companies turn out to be value traps, right? So you must look at the business itself, whether it can grow and whether it's sustainable or not. All right. So that hopefully that's my answer. The price may or may not be higher than the balance sheet, right? Sometimes it can be below. I've seen cases where it's been below. Okay, the last one. Do you look at cash flow, capex? Yeah, of course. Because it's a basic introductory. I normally teach this over a day and a half. But yes, I also look at cash flow, excluding capex to get you more. So cash flow excluding capex would be cash flow from operations, right? If you want to get cash flow including capex, you call it free cash flow, which is cash flow including investing activities as well, right? And this will give you an accurate picture. But cash flow from operating activities really will already tell you how much cash the business will generate. The capex portion will only come in from cash flow from investing activities, right? So I hope that clarifies. That. Okay. 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 I won't be able to comment specifically on stocks on this session. Specifically, that can come to advice. But this is from Shamin, right? Healthy, wealthy, good condition. Would you consider divergence in share price? So right now, I'm not talking about price. I'm going to say that when you look at the business, these are the three aspects that you need to look at, right? So the question about price is about timing, okay? If it's only wealth, could it be a takeover? Yeah, I mean, but SC has now tightened out their takeover rules right now, so it is quite tight. I wouldn't say it's that easy to maneuver a takeover. If you're only trying to take over on balance sheet, it's possible, but more than 90% of the shareholders need to accept it. All right. Yeah, I do apologize on the wrong link sent. You can download today's slides and please give us feedback. I would very much appreciate it that if you guys can give us feedback. All right. Okay. Do you ever discover something in the financial report that can keep you awake at night? Well, I just don't invest in it, right? So you don't have to keep it. You don't have to keep awake. But I think some of the numbers that can be tricky would be receivables, right? Especially companies that do very good sales and almost looks perfect, but its receivables are a bit probably too high for the industry standard, right? Then you kind of determine whether it's real or not. I think one of the key points I want to look at is receivables and potentially the company taking on too much debt, right? So if it's too much debt, then I know that's a risk, but depending how sexy the business is, right? So if, for example, if you look at airlines today, airlines typically take on quite a bit of debt because when they buy planes, right? I can tell you the CEOs are probably not sleeping at night. If you're an airline CEO today, that's definitely going to keep you awake. It's actually the debt that you have to repay, right? And when your business gets stranded and you have no cash flow, it gets quite, it's going to be a very, very monumental task. All right. So that's something I normally look at. Debt. I normally look at receivables. And in addition to everything else that I look at. Okay. Okay. So. Okay. Now this is a good question here. Today's session is very much about. It's not about valuation. I just wanted to give you guys an idea on the risk that you're going to be taking when you invest in shares, right? Of course, there are methods to figure out if a company's share price is overvalued or undervalued, right? Probably another session we're gonna have. Look, we're gonna be here educating you guys for 10 sessions, and these sessions are all brought to you by �11 Malaysia, right? So stick around. I believe this is our 5th session, so we've got another 5 more sessions. Just remember to invite all your friends to come every Saturday night 8 p.m. To literally get free investment education. All right. Okay. Okay. If there are any questions, happy to answer them. Otherwise, we are almost close to 90 minutes, right? So I hope today's session was useful for you guys. Again, would appreciate if you guys can help me do a very quick survey. This is for �11 Malaysia to make sure that we're still going to be around the next Saturday, right? Okay. Right. Okay. Probably last question. If it's a property stock, in general, it looks like a value trap because they are asset rich, right? But if you follow value investing and they're a good paymaster, is there any way to separate good from bad? I think when you say property stock, I believe you're saying property developers, right? Okay. Now the problem with property developers is, yes, they are all asset rich because it is part of their business. They have to invest in land over the long term, right? They must. Otherwise, what do they have to develop, right? And typically long-term holders of them. And of course, when the location gets ripe enough, they will develop, and that's where they make profits. Generally, for property investors, property developers, it's tricky because their cash flow and their revenue and their profit, it's very transactional, right? That means sometimes it happens, sometimes it doesn't happen, right? And this makes it very, very difficult to actually predict future cash flows, right? So they look very value rich, but because a big component of their business is typically one-off and non-recurring, that's why you can see that their PE values are typically lower. Okay. I personally don't invest in property development stocks per se, right? That's not my cup of tea because I can't at any point measure the recurring, right? And of course, all the GDV numbers look very, very impressive in billions, right? But I normally steer away from those companies, not because I don't like the management or anything. It's just really the industry is too much, which is one-off and non-recurring. All right. Okay. What are the financial cues you take to exit an investment in an investment grade or emerging grade company? Well, look, if it continues to do well, I will continue to hold it. But of course, at some point when it gets overvalued, and I think for investment grade, one of the easy ways to measure them is using the PE ratio, right? It is a fairly decent valuation technique, right? When they have health and they have condition but not wealthy, PE ratios are a good gauge, right? So when PE ratios get way too high, it's time to take profit because investment grade stocks normally don't have that kind of double-digit growth that you can get with emerging grade stocks. All right. So I hope that gives you an idea. Okay. Which is more important, profit or net cash or net tangible asset of a company? To me, profit is secondary. Net profit is secondary. Cash flow is more important. Cash flow and net cash, if I were to choose. Net tangible asset, not so much. Profit definitely last on my agenda. I know a lot of investors like to look at profit, but I prefer to look at cash flow, right? Because you can make an accounting profit but not make cash flow, right? Okay. Okay, question from Shamin. In a conglomerate, yeah, conglomerates are tricky, right? Because they can also be a value trap because they've got like 5 or 6 major industries, right? And in the 90s, it was very popular to have conglomerates, right? So despite them looking healthy, wealthy, in good condition, they could also be, you're right, a value trap. Why? Because if one division goes up and the other division goes down, you normally don't get it reflected in the share price, right? So in fact, what has happened from being conglomerates being the key thing that in the 90s they were doing, or 80s, now they're moving into what we call divestments, right? Or they split them up into clearer chunks, so you can actually the valuation is more reflective of the existing business. All right. Look, I hope I hope you guys found this session interesting and useful. Do stay tuned. Tomorrow we will be back at 8 p.m. Of course, next Saturday, again, another session brought to you by 𝗏𝘚 Malaysia. All right. I wish all of you guys a great night. Thank you very much for tuning in. And I'll hope to see you guys tomorrow or on the next session again. Thanks again. Good night and bye-bye.